mind, looking for a dime. James Locke in the house, gonna help you shine.
Welcome to the Pool Locke YouTube channel. I'm James Locke. Today we're going to answer some Ask James questions of the day. So the first question comes from Daniel. He says, I want to talk to my kids about our legacy and do some estate planning, but I really don't want them to know how much we have right now. How can I do this? All right, Daniel, this is a great question. And, I hear it more often than you might think. Now, the good news is that you can absolutely have these conversations without disclosing your net worth. And it's often better to separate the what from the how much. Your children don't need to know the size of your estate to understand the structure of your plan. What they need to know is who will be responsible for what and what the process will look like. So for example, they should know who your healthcare agent is, the person who makes medical decisions if you're unable to. They should know who your finance power of attorney is. They should know where to find most important documents, who to call, and how your estate will be administered. All of that can be communicated clearly without ever discussing specific dollar amounts. Another strategy is giving small, controlled gifts while you're still alive. Not large amounts, but modest ones that let you observe how your children actually handle money. Do they save it? Do they invest it? Do they make good decisions under financial pressure? This gives you real insight to help decide how much structure or flexibility to build into your estate plan. And if you're concerned about an irresponsible heir, consider a trust. A revocable trust during your lifetime can it'll turn into an irrevocable trust after your passing, meaning your children can only access the money according to the rules and conditions you set. Income distributions only, lump sum payments at specific times, or funds restricted to purposes like education, healthcare, or buying a home. So you're not alone and you're not stuck. You can have the legacy conversation without revealing the numbers. And you can structure your estate to protect your children, honor your intentions, and preserve your wishes even after you're gone. Great question. If you want to send in your question like Daniel did, you can email it to poollocke@poollocke.com. Our second question is from Ed. He says, you mentioned taking required minimum distributions from interest and dividends in order to protect your principal for healthcare issues later in life. But what if I bought long-term care insurance instead? All right, Ed, you're actually talking about two separate issues, really, though related issues. How to cover long-term care needs if they arise and how to protect your principal over the long run. They're connected, but they're not the same thing. They are essentially two ways to cover long-term care needs. One is to self-insure, having enough liquid assets to cover the cost yourself. The other is to transfer that risk to an insurance company. But you have to be healthy enough to qualify, and even if you are, premiums can be substantial and have historically increased over time. Generally, people who self-insure have at least $3 million in liquid assets. Now, those with less often choose insurance to avoid depleting their savings. But even high net worth individuals sometimes choose insurance simply because they prefer to transfer the risk and keep their assets fully invested. Here's the key point. Regardless of whether you buy long-term care insurance, you still want to protect your principal through an income-first strategy. So those are two separate decisions pointing towards the same goal. So selling principal exposes you to market risk and can permanently impair your financial foundation. Generating income from interest and dividends protects that foundation with or without insurance covering your care needs. So if you plan to retire at 65, generally start transitioning toward an income-first strategy in your mid to late 50s, gradually repositioning as you approach the date when you'll need the income. The shift should be fully in place before you actually need it, not in the middle of a market downturn when your options are limited. So To sum it up, long-term care insurance is one decision that affects how you cover potential care costs. Generating income from interest and dividends is another decision that affects the long-term care health of your entire portfolio. Both matter. Both belong in a comprehensive retirement plan. Two great questions today. If you have a question you would like answered, email it in to us to poollock@poollock.com. If you like what you heard, go ahead and like and subscribe to our channel. I'm James Locke, your retirement income source. I'll see you next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear.